Welcome to Steady Investing. This week, a handful of ETFs took some of the sharpest hits we've seen this year. And whenever something drops hard, the first question is always the same. Is this a problem or is this an opportunity? The honest answer is it depends. Not every deep pullback is worth catching. What drove this week's sell-off? Three forces hit at the same time. The Fed turned more hawkish than expected. Oil surged above $100 as the Iran conflict deepened and the Strait of Hormuz stayed closed. And the dollar strengthened, which puts pressure on everything priced in dollars. Gold, silver, miners, Korea, they all got hit from the same direction. But here's what's interesting. Most of these ETFs were already coming off historic highs. So what we're seeing isn't a collapse of broken assets, it's a correction after a parabolic run. Those are very different things. Let's go through them one by one. EWY, South Korea. The Korean market has been driven by the massive AI momentum in semiconductors, but as a major energy importer, Korea feels oil shocks immediately. The exit this week was fast and sharp. However, the structural AI story is still intact, but after such a rapid run, corrections can be deep. Patience is more important than speed here. Keep your positions small and wait for the volatility to settle. GLD, IAU, GLDM, Physical Gold. Gold had an incredibly tough week. For patient investors, this is a time to watch closely and entry slowly. Remember, the floor can always find a new floor. GDXJ, Gold Miners Junior. Junior miners amplify gold's moves, both up and down. There's an added pressure here. High oil prices increase mining costs directly, squeezing margins from both sides. Miners carry equity risk on top of commodity risk. If you're watching GDXJ, your threshold for adding needs to be significantly higher than for physical gold. These move fast and they can go lower than you expect. SLV, SIVR, Physical Silver.
Silver gave back a large portion of its recent gains very quickly. Silver serves two masters, gold and industry. When gold sold off and industrial uncertainty crept in, silver got hit from both sides. But the supply deficit and growing demand from solar and AI data centers remain the dominant long-term stories. PPLT, Physical Platinum. Platinum pulled back hard, but the supply deficit is still the reality. Platinum is less liquid than gold, meaning moves in both directions are often exaggerated. Stick to the levels. TQQQ, Nasdaq 100 Bull 3X. TQQQ is a completely different category. This is a 3 times leveraged daily product, and that changes everything about how you approach it. The Nasdaq pulled back this week on Fed hawkishness and tech uncertainty. TQQQ amplified that move 3 times over. That's exactly what it's designed to do. Here's the critical thing about leveraged ETFs. The entry threshold must scale with the leverage. Where a 5% pullback in QQQ might be worth watching, you want to see something closer to 15% in TQQQ before considering any entry. 3 times the leverage means 3 times the required pullback before the math starts working in your favor.
And the exit strategy matters just as much as the entry. TQQQ is not a buy and hold position. When it moves in your favor, scale out systematically. Don't wait for a perfect top. The same leverage that accelerates gains on the way up accelerates losses on the way down. TQQQ has previously dropped more than 80% peak to trough. That's not a warning, that's a fact. Anyone holding this needs to understand that before the first entry. SOXL, Semiconductors Bull 3X. SOXL carries the same structural risks as TQQQ, times 3, but concentrated entirely in semiconductors. The semiconductor sector is particularly exposed right now. AI chip demand remains strong, but the geopolitical situation adds layers of risk. Taiwan, Korea, supply chains, all under pressure. Energy costs rising hit semiconductor fabs directly. Korean retail investors, the so-called Seohack ants, have been pouring money into SOXL, hundreds of millions of dollars in single trading sessions. When retail concentration gets this high in a leveraged product, the exits can be violent when sentiment shifts. SOXL has dropped nearly 90% twice in the last 4 years. Not a typo, 90%. Entry thresholds must reflect that, and position sizing must reflect that. A small allocation that triples on a good run is useful. A large allocation that drops 90% is devastating. Same rule as TQQQ, 3 times the pullback required before considering entry. Scale out when it moves in your favor. TKEL, Tech Sector Bull 3X. TKEL tracks the broader technology sector, not just mega-cap names. Software, hardware, semiconductors, cloud, all in one 3 times leveraged product. The tech sector has been under pressure since the Fed signaled a more hawkish stance. Higher rates compress growth stock valuations. TKEL amplifies that compression 3 times over. Same framework applies. Higher entry thresholds, smaller positions, systematic exits. And here too, the 5-year recovery numbers show the long-term potential, but the path between entry and exit in leveraged ETFs can be extremely painful if the timing is wrong.
That's this week's biggest movers. What ties all of them together? They were either momentum trades coming off historic highs or leveraged products amplifying an already volatile week. None of the structural stories collapsed, but the corrections are real, and in some cases they may have further to go. The framework stays the same. Small entries, multiple levels, never concentrated. Always keep capital for the next opportunity. For leveraged ETFs specifically, remember the rule. The entry threshold scales with the leverage. 3 times the product, 3 times the required pullback before the math starts working for you. Buy broad, buy cheap. Stay safe, stay in the game. Educational content only, not financial advice. Stay steady.